They're telling you to watch oil. They're telling you the Venezuela story is about crude, barrels, tankers, gas prices. But that's the decoy. Because the real winner of this crisis, the metal that benefits from chaos, from choke points, from retaliation, from insurance shock, from supply chain fear, is silver. And I know that sounds backwards, because silver doesn't feel like a war asset. It feels like a boring industrial metal. But that's 2024 thinking. Welcome to 2026, where industrial metals are strategic weapons and supply chains are battlefields. And right now, the Venezuela crisis isn't just disrupting oil narratives, it's repricing the entire commodities map. Today, I'm going to explain why. And by the end of this video, you'll understand one thing clearly. This crisis doesn't make silver weaker. It makes silver scarcer. And scarcity doesn't negotiate. The real shockwave is not Venezuela. The headline story, Venezuela. The perceived asset, oil. But the system doesn't price headlines. It prices risk transmission, and risk transmits through 3 channels: shipping routes, insurance, plus financing retaliation via strategic materials. Oil is obvious, silver is hidden. That's why silver moves after the headline. But when it moves hard. Because silver isn't just an investment metal. Silver is solar infrastructure defense systems, EV power electronics, grid, modernization data center, power conversion, medical and industrial chemistry, critical connectors and coatings. Oil fuels the machine. Silver is inside the machine. If oil becomes expensive, you pay more to run the machine. If silver becomes scarce, the machine can't be built. That's the difference. The supply chain, choke point. They're not talking about. Here's the first thing you need to understand. Supply doesn't have to stop. It just has to slow. And when it slows, even by a few percent, a deficit market doesn't adjust. It panics. Silver is already a deficit market. The Silver Institute's interim 2025 review describes a multi-year deficit environment and still projects a 2025 shortfall. So now imagine you add maritime instability to that. And yes, people get confused here. So let's be precise. Peru and Chile, major sources of silver output, ship primarily out of Pacific ports. So you might say, Caribbean naval activity doesn't touch Peru-Chile exports to Asia. Not directly, but markets don't only price the physical lane, they price global war risk insurance, reinsurance, credit terms for commodity cargoes, delays in transshipment port congestion from rerouting the Panama Canal plus Caribbean risk premium for Atlantic-bound flows, and the psychological fear that retaliation is coming, and fear in a deficit market is gasoline. Now layer the reality that U.S. actions around Venezuela have been described in terms of an oil quarantine, shock, blockade posture. Even if you don't believe a single ship gets stopped, the insurance market hears blockade. The financing market hears sanctions plus seizures. The industrial buyer hears get inventory now before the paperwork gets ugly. That's how silver wins. Because silver is not priced like oil. Oil has buffers. Oil has OPEC. Oil has spare capacity games. Silver doesn't. Silver is a small market, and small markets snap. Most people don't know where silver really comes from. They assume mines. They assume big stockpiles. Wrong. A large chunk of silver is produced as a byproduct of other metals. That means silver supply is not easily ramped. It's tied to copper cycles, zinc cycles, lead cycles, and the geopolitical map matters. According to the USGS Mineral Commodity Summaries 2025, Mexico leads mine production, with China and Peru also among the top producers. So Peru and Chile aren't the only nodes. But they are critical nodes in the Western supply chain mindset because they feed refiners, they feed trading houses, they feed industrial procurement pipelines, and they sit inside a region where political shocks spread. Now add Venezuela instability into the same hemisphere. You don't need Peru to collapse. You just need delays, port disruptions, higher insurance, higher financing costs, and strategic hoarding by buyers. Because in a deficit market, buyers don't wait for confirmation. They front run. Here's the real weapon. Silver is now a strategic resource. Fight. Now we get to the part that turns this from regional crisis into global squeeze. China. China is the world's biggest silver consumer for industrial use, especially in solar and electronics. And what happens when a world power feels its interests are being targeted? It doesn't just respond with words, it responds with bottlenecks, with licenses, with export permissions, with strategic resource policy. And this is not theory. Reuters reported that China's Ministry of Commerce named the companies allowed to export silver during 2026-2027, 44 companies, and framed these metals as critical to support domestic industries. Read that again. Not the market decides. Not any exporter can ship. 44 approved pipelines. That is a control lever. And once a control lever exists, it can be tightened. This is why the Venezuela crisis matters more than people think. Because if geopolitical pressure escalates against China's interests in the region, silver becomes a retaliation tool the way rare earths were used in previous eras. Not because silver is a meme, because silver is embedded. You can't replace it quickly. You can't build 2026 energy infrastructure without it. So when licenses tighten, the West doesn't just pay higher prices. The West faces a worse threat: allocation. And allocation is where shortages become real. Forget oil means this. Oil is a story. Silver is a bottleneck. Here's the brutal comparison. Oil shocks are loud. They hit the pump. Politicians react fast. Strategic reserves get released. OPEC smiles. The system has muscle memory. Silver shocks are silent. They show up as delayed delivery, exploding premiums, manufacturers bidding against each other. We can't secure feedstock. Calls, contract renegotiations, force majeure language creeping into supply agreements. Oil is a consumption commodity. Silver is a construction commodity. Oil is burned and replenished. Silver is consumed industrially and often does not come back. Once silver goes into electronics, photovoltaics, specialized coatings, it's effectively removed from easy circulation. That's why silver crises don't look like oil crises. They look like nothing. Until suddenly, everything breaks. Now we talk price behavior. Gold is the headline safe haven. Silver is the leveraged expression of the same fear, plus industrial demand. So when crisis money flows in, gold moves first, silver moves harder. Why? Because silver is smaller, less liquid, more squeezable, more sensitive to marginal buying. And when the world is unstable, marginal buying becomes strategic buying, not a trader buying 2 contracts, a procurement manager locking 6 months of supply, a sovereign fund diversifying into hard assets, a manufacturer refusing to be the last buyer in line. That's when silver doesn't rise politely. It gaps, it spikes, it prints ugly candles, and then everyone pretends they saw it coming. Let's say oil markets stabilize. Let's say Venezuela headlines cool. Does that fix silver? No. Because the demand side in 2026 is not optional. AI data centers are being built. Grid upgrades are accelerating. Solar installations continue because governments and utilities don't stop mid-transition. Defense procurement doesn't pause because silver got expensive. This is inelastic demand. An inelastic demand meeting constrained supply equals one thing: price discovery. Real price discovery. Not the paper price. Not the we can roll it price. The price where industry says, I will pay whatever it takes because the factory must run. That's when silver stops behaving like a commodity and starts behaving like a strategic asset. So what is the actual thesis? It's not, Venezuela happens, silver goes to the moon. That's childish. The real thesis is, Venezuela crisis increases regional instability, plus blockade, operations, risk perception. Risk perception raises the cost of moving commodities and raises fear of future bottlenecks. China already has the export license lever for silver and can tighten it further. Silver supply is already structurally tight and has been running deficits in recent years. Industrial demand is inelastic into 2026. Therefore, the winner is the asset that is both safe haven adjacent and industrially irreplaceable. That asset is silver. Oil might spike, but oil shocks get managed. Silver shocks get rationed. Let's be responsible. There are three possible paths. Scenario A: crisis cools, policy stays tight. Even if Venezuela headlines fade, the export license regime is still in place. Silver remains supported. Scenario B: crisis escalates, retaliation tightens. This is where silver becomes a geopolitical pawn. In that case, premiums matter more than spot. Scenario C: macro risk-off hits everything temporarily. Yes, silver can get smacked in a liquidity event. But liquidity events are not thesis killers, they're transfer events. They move metal from weak hands to strong hands. So what do? If you're trading paper, manage leverage, respect margin, avoid being forced out. If you're investing, think in ounces, not candles. If you're buying physical, focus on availability plus premium behavior more than spot. And most importantly, do not confuse volatility with failure. Volatility is the signature of a tight market. They want you focused on oil because oil is loud. But silver is the quiet limiter. Oil headlines hit your emotions. Silver shortages hit your supply chain. And this Venezuela crisis is not just an oil story. It's a story about choke points, leverage, retaliation, and who controls what flows. And the world is moving, fast, toward a reality where metals, our strategic exports, are licensed, and free markets become approved markets. So if you're asking why silver is the real winner, because silver isn't just a trade, it's a bottleneck. And bottlenecks set the price of the future.